Tony, welcome back to the show.
Tim, thanks for having me. Good to see you.
Good to see you as well. And as always, excited to have you on as our mortgage lending expert to bring great information to our community and audience. And we're going to talk about the A to Z of the mortgage process, all the way from pre-approval to closing. But before we do that, as I always do, I want to ask and get your take on what the heck is going on in the market? Where are we at? And what might 2025 bring? It feels like we've had this conversation a few times of, hey, rates are stubborn, supply is limited, demand is high. What do you see out there in the market and what's ahead for the year?
Yeah, all good questions, Tim. And it's definitely interesting times. A lot going on. Different markets can vary a little bit, across the country, clearly. But we are seeing more inventory. So that's the good news for buyers. There's more
Hmm.
inventory of existing homes on the market than there's been in some time. So the inventory levels are increasing. I would say that one concern obviously is inflation. Inflation is it has yet to be completely beaten in the Fed's eyes, right? So I think I think we're going to see inflation ease down probably in the coming months because year over year inflation, it reports will factor in some lower months, April, May, June of
Right.
last year into the annual figures. And I think you're going to see that inflation rate come down. Also, got to watch the unemployment rate too,
Hmm.
because the unemployment rate is near all-time lows, but I think that could tick up a little higher. And if that does, even just fractionally, that can help with interest rates. So I do think there's a chance rates could be a little bit better in the next 6 months, but I wouldn't bet on like a really, you know, seeing anything like the 2021 or 2020
Hmm.
time. But overall, the economy is pretty healthy. There's just risks to watch, and I think rate wise, it's inflation, and but then there's some areas that have been hit. Obviously LA with the fires,
Yeah.
right? Florida with the hurricanes. Housing markets are affected by that, and we see. I'm based in Florida, and we can see like this fragmented market where certain areas that weren't affected by flooding have all-time highs in prices
Hmm.
where issues along the coast some of those homes have been hit pretty hard and the values are down. Probably an opportunity in the long run, but it's just there is some fragmentation to the housing market. But overall, I would say, um, inventory levels being higher is going to help buyers.
Yeah, it's good to hear. And I think we need to stop bemoaning the interest rates of 2020, 2021, and those days are gone, right?
They're
And,
gone.
we've
They're
got a
gone.
new reality. Maybe they come down slightly. If those days come back, there's going to be an opportunity, obviously, to refinance. But we've got this new reality in front of us. And Tony, what I'm hearing from a lot of pharmacist home buyers, especially first-time home buyers, is salaries have remained relatively flat. Some have seen a substantial increase. Student loan debt is still a thing, very much for a lot of our audience. But the home prices and the appreciation that's happened alongside of the interest rates that have gone up, it's really changed the affordability question, for a lot of pharmacists, especially first-time home buyers. And for many, I think it's changed that expectation of what might be within budget. And I want to start there as we talk about the A to Z of the process from pre-approval to closing, because I think first and foremost, we have to know our budget. We have to understand that what are we able to afford and our own financial plan. And I'll get your take in a moment here on kind of how the bank makes this determination. But it's really up to you as the individual to determine what mortgage payment with principal, interest, taxes, and insurance, referred to as PITI, works with your income, your expenses, your various goals. Keyword being your, right? Everyone's situation is different. And any mortgage calculator, and we've got a YFP mortgage calculator that we can link to in the show notes as well. Any mortgage calculator will ask you for inputs on what's the target loan amount, what's the down payment, what's the interest rate, what's the term, what's the taxes, and the insurance aspects of the buy as well. And all of those things we have to factor into as we're looking at how does this home purchase, how does this decision factor into the broader financial plan. So Tony, I'm going to stop with my rant on, how people need to be thinking about their individual purchase and how it fits into the broader context of their plan and their goals, and get your take on how the lender determines what the buyer can afford. Because early on in this process is going to come a pre-approval, but before we get that pre-approval, we have to understand how the bank thinks about the lending decision and what ultimately a home buyer can afford.
Right. That's right. So all lenders are required to prove, it's called the ATR rule, the ability to repay. Pretty simple,
Mm,
but
hmm.
it's banks and lenders have to show that the borrower has the ability to repay, and there's certain documentation that's required as a result of that. So that's why lenders will ask for your pay stubs, tax returns if you're self-employed, bank statements, asset statements, work history. They're required by law to prove, per that rule, right? The ability to repay
Hmm.
the loan. So I would say that, you hit it on, you hit it right on there, Tim. I mean, you want to prove, first of all, backtrack before you go to a lender, get your own budget together. Like, what can I afford? What
Yeah.
really can I afford? Because the lender might be able to approve me for more than I'm willing to pay, right? That does happen. You might have a travel budget, you might have a savings goal, right?
Right, right.
And you come in and you say, well, wait a minute, I can qualify for the 800,000 or a home, but I don't want that, right?
Hmm.
It's because my budget doesn't allow that. So I think having your budget's important. I think the other thing, us as lenders are going to look at your debt to income ratio. So that's the buzzword here, debt to income ratio. So as a lender, we assess you based upon how much income to debts that you have per month. So let's just say your income's $10,000.
Hmm.
Okay, it's your gross income. And lenders always use gross income. If you're W-2, we use your gross, not your net. So that's been a question over the years that I've received, and
Yep.
we use your gross income. And let's say your liabilities before the mortgage are $4,000 a month before you get a mortgage. Well, typically, we're not going to lend you more than a 43% debt to income ratio. So already right there, if you're paying 4,000 a month in debt, let's say it's student loans, you have a couple cars, it's 4,000 a month. There's not a lot there to buy a home.
Hmm.
So that's how lenders look at it. It's based upon the debt to income ratio, and that's a simple way to illustrate it. Is if your gross income's 10,000, your liabilities are 4,000 a month, where you're at a 40% debt to income ratio. Most programs are 43%. There are a few that'll go up to 49% debt to income ratio, but that's generally where you're going to be. So, and that includes the new mortgage. So that's how lenders look at you as a borrower. We have a ratio to your income to your liabilities, and that's how we prove the ability to repay the loan.
So, Tony, when a lender's looking at that ability to repay the loan, the ATR rule that you mentioned, the debt to income ratio, um, inclusive, of course, of what that new payment will be, is that principal and interest only that they're
It,
factoring in?
it's PITI, which you
PITI.
mentioned before.
Okay.
Yeah, it's
Yeah.
PITI. So taxes and insurance matter as well. So
Okay.
it's that's entire collective amount. Um, so that's how we review it. And again, it's all borrowers on the loan too. So if you have a spouse that's on the loan with you, obviously we use your spouse's income as well. So it would be collective income, or
Hmm.
if you have a co-borrower, uh, it would be collective income. So that's one way folks are able to qualify
Hmm.
for more, you know.
And
Um,
collective debt too, right?
Collective debt as well. That's right. That's right.
Yeah.
But you got to remember that too. That's true. It is collective debt, and it's collective credit scores. People don't always realize that too. If one spouse or co-borrower
Hmm.
has lower credit scores, that can influence the loan pricing. So that's something to keep in mind too. Even if the other borrower, the main primary borrower, has better credit.
I have a question about credit that I want to come back to here in a moment, but
Sure.
I want to first tackle what I'm guessing many of our listeners are thinking as they hear you talk about the ability to repay rule and the debt to income ratio, which is my student loans, right? We certainly do have people that may have some credit card debt, some car debt, other debt that may be hanging around as well. But student loans tends to be the girl in the room when we think of many pharmacists, especially first time home buyers. We might have some listening that are thinking about a home buy that's not the first time, and maybe the student loans are gone, and certainly that would free up some things on the debt to income ratio. But if we think of a traditional pharmacy graduate coming out with 170, $175,000 in student loans, depending on their loan repayment plan, that can be a sizable monthly payment. So if you put that debt on a standard 10-year repayment, you're talking about $1,900 to $2,000 a month. On the other hand, you might have somebody that, is looking at an income-driven repayment plan and they're really optimizing the calculation and they've got that down substantially, maybe 5, 6, $700 a month. Wow, that can have a big impact, Tony, on how that gets factored in.
Huge.
So, given all the uncertainty right now about student loans and what's happening and people that are on pauses because of the uncertainty with the SAVE plan, how are lenders thinking about student loans? Are they applying a generic calculation or are they getting to the level of detail of, hey, this person's on a standard repayment, this person's on an income-driven repayment?
Yeah, it's a great question, Tim. So a couple of things. The first thing is most clients that come to us are already kind of ahead of the game. They have one of those two options. I find the income-based repayment plan is what we like to see, right? That's what normally is what I see,
Yeah,
because the payment is then gives them the ability to borrow more and buy a home, or pay rent or whatever it might be. So normally we see that income-based repayment, and that's what we encourage everyone to go to if we can. There is a factor though, for those that aren't quite set up, there is a factor that we have on some of our programs that takes a factor of the loans. So like, for example, one of our products is at 0.5% of the balances per month. So if you had a $100,000 loan, that would be a $500 a month payment, right? Where Fannie Freddie are typically 1% a month.
got it.
Conventional loans or
Hmm.
FHA. So there's some products out there that can give you a little bit more flexibility, which is needed a lot of times in with your clients,
Hmm.
and the audience. But I find that the income-based, I would encourage everyone, if they can, if they have that option, the income-based repayment is going to give you the most flexibility and allow you to have the kind of the best approach to financing a big purchase like a home. Because if you have that 10-year, like you said, $1,900 a month versus maybe $500 a month, really locks you in. It doesn't give you a lot of capacity to
Hmm.
borrow.
It's interesting. There's a lot of strategy here. And, I'm thinking about more of the work that our planning team does, where not any one decision's in a style. This is a great example where if you've got
Yeah,
student loans that you're paying off and you're thinking about buying a home, you can't look at those as independent variables. And of course, there's many other parts of the plan as well. But knowing the debt to income ratio is based on gross income, I'm specifically thinking about our folks that work in the nonprofit sector that might be pursuing something like a public service loan forgiveness strategy that are on an income-driven repayment plan and are optimizing that plan, not advice, but just kind of talking about how the calculations work. And they're optimizing that plan by really making contributions to, traditional 401ks or traditional 403bs. They might be making HSA contributions, other types of things where they're reducing what that monthly payment will be through the calculations of the income-driven repayment plan, all the while making their debt-to-income ratio, more favorable, and of course having more loans that would be forgiven and ideally forgiven tax-free. So, just a great example where, hey, if I've got student loans and I'm going down this pathway, this strategy, and I'm also thinking about buying a home, we got to bring these two discussions together and figure out how the different pieces of the puzzle ultimately work together. So credit, I
absolutely.
want to come back to my credit question, Tony. What role does a credit score play in getting a mortgage? I think the obvious being, of course, better credit is going to be more favorable lending terms. But for our listeners that especially are going through this for the first time, like how much does credit matter when it comes to not only getting approved, but getting the best products at the best rate?
Right. Well, credit is critical, to all of the lending world. Uh, Obviously, income is super critical too, because you have to show the ability to repay.
Hmm.
But a lot of programs now, Tim, they have minimum credit scores. So if you don't meet that threshold, you're not qualified. So, and like us as an institution, as a bank, we have a minimum credit score. Depending on the products, some are lower than others.
Hmm.
Uh, but credit scores matter to rates as well, right? It's a big influence on rates. So if you have, a lower credit, and that can dictate what product I'm going to recommend too, right? So if your credit score is a little bit lower, let's say you have a 620 credit
Yeah.
score, and you come to me with less money down, and I can maybe get you qualified for conventional or FHA. Well, I may say FHA in that situation because the rate may be better based on your credit score. So everybody's a little different. Everyone's situation's different, but credit scores are very important. And I'll just mention a couple quick things. I'll just add this in, Tim. I just couple things just from my years of
Yeah.
doing this, 22 and a half years of this industry, is mistakes. And I brought this up in the past, maybe a couple years ago, but I'll just reiterate it. And one thing where most people get caught up is I find a lot of my clients are concerned about inquiries, right? Oh, my credit's run, I'll have an inquiry. And inquiries are the least amount impactful on your credit. You don't want a whole bunch of them, and you definitely don't want a bunch from multiple creditors,
Hmm.
if you're getting credit cards and things like that. But where I see the biggest mistakes is credit card usage. So if you have a $5,000 Visa credit card and you go and you buy something for 4,500
Hmm.
and it's not being paid down, that hits your credit much worse than an inquiry. And the other thing I see is buying furniture, buying TVs when they give you no interest for a year. It's
Yeah.
a great deal. And I even did it on one of my first homes when I was in my mid 20s. And I'll never forget, my credit score went down 60 points because I
Hmm.
had multiple maxed out credit cards for this no interest for a year. So that's just a couple of things that, younger buyers and any buyer can look at. But you want to make sure all your payments are on time. And the credit score is very, very important. And one other thing I'll mention as well is monitoring services. The monitoring services do not always tell you exactly or specifically what your actual credit score is that a creditor like us is going to see. Okay. They're going to give you trends. Like I have some people tell me, oh yeah, my score is 860. Well, they don't even go that high. Okay. So, and you'll run the credit report and it's 770. And it's just because that's still a great credit score, but the tracking services are not the
Yeah.
same as what we're looking at. So I try to encourage people that it's great that you subscribe to that. It does give you overall trend, but that is not exactly what a creditor
Hmm.
score is going to be.
So you're talking about like a Credit Karma or some service out,
Yes.
right? Okay.
Yeah, yeah. I think some of the credit card companies Discover, they
Yeah.
offer these services that track your credit, and people will even scan these to me and say, "Hey, this is where I'm at," and
Hmm.
and it gives me a good trend, but that's not what your scores
Hmm.
are. So,
Yeah. And
and then
what,
there's three scores that lenders look at
right.
as well. Okay, so that's another thing I want everyone to know is there's Experian, Equifax, and TransUnion. Those are the three large, basically repositories of credit information.
Hmm.
And when lenders, mortgage companies run your credit, we use the median score, so your mid score.
And I think your discussion of credit is just such a good reminder here in the home buying process, but as an overall part of the financial plan, I feel like credit, kind of like tax, right? It has a thread that runs across everything.
Mhm.
And we've talked at length, not only you and I, but we've also done some other episodes on understanding credit scores, why it's important to check your credit report, understanding the components and makeup of the credit score. You were talking about utilization there just a few moments ago. The more you know about credit, the more you can start to understand. And especially thinking about our listeners, Tony, that maybe they're saying, hey, I'm going to buy a year out, 2 years out, or I'm not even thinking about it now. What a great time to really solidify your credit so that when you get to that point in decision of buying, you're ready to go and you've ultimately made your credit the best that it can be. So such an important topic.
Exactly.
All of this, Tony, leads up to the pre-approval. So as we wrap up this first section, we're talking about pre-approval budget. The bank's going to ask us to submit a bunch of information that's going to help them determine what is that ability, right, that they have to be able to lend a certain amount of money. And through the submission of information in terms of pay stubs and work history, we're obviously doing a credit pull and check as well. They're going to then hopefully issue what would be a pre-approval. So remind us of that pre-approval. Why is that pre-approval so important and how that differentiates from pre-qualifications, which I'm seeing more and more out there as well?
Yeah, another good question. So a pre-qualification is not validated data by a lender, right? So it's basically a lot of online services and pages have this where you can pretty much or verbally supply your information. So if you were to call and say, Tony, I make 100,000 a year. I have two debts, two car payments at 500 a month, and that's it, right? And then you would send out, nothing's validated, right? Credit score might not be run. I haven't seen your pay stubs, haven't seen your W-2s, haven't seen your credit, like I mentioned. So it's verbal data, right? And that's why those letters generally don't carry much weight in the real estate community. So if you go to a realtor and say, I want to make an offer, or I want to work with you to find a home, a lot of times they'll say, well, do you have a pre-approval?
Mm-hmm.
And if you answer no, I have a pre-qualification, they're not going to put much weight in that. So the pre-qualification is fine just for basic knowledge. I think if you're just trying to think ahead of time, you're a few months away from really getting into the home buying process, it's fine to do that. Like I give verbals to people all the time. They'll call me, especially past clients, to say, do you just kind of thinking about this, and does this make sense? But we're not going to give them anything in writing like that. It's
Mm-hmm.
more just a conversation. But when you're ready to go look at homes and walk into open houses, a lot of times they're going to want that letter. So that
Mm-hmm.
pre-approval letter carries a lot more weight because we've ran credit, we've seen your income, whether it's W-2s or pay stubs, we've seen your liabilities. So then we can say, okay, in writing, this client is approved for this $700,000 mortgage. And a lot of times the listing agent will want that before you even go into
Mm-hmm.
the house. Just depends on the area and the situation, but a lot more weight is given to that pre-approval letter. And those are generally good for 90 to 120 days. So you got some length before you have to update them. But yes, so big difference. It's validated versus unvalidated would be a good way to say it.
Yeah, the way I think about it, Tony, is, that letter, that pre-approval letter becomes the key, if you will, that you
Right.
can really go out, work with a realtor and put in an offer, and feel good about the process moving forward. And I'm glad you mentioned the timeline, 90 to 120 days, because I think that's one thing that first-time home buyers especially might not be thinking about is how long does that last? And ideally you start this process because it's going to take time, right, to gather all of your documents. And I'm thinking about the last time, Tony, that I even went through this with you guys. Like you've got an online portal, helps you kind of walk through each of the individual steps. You can't submit right until you have all the check boxes of the individual items uploaded, and it can just take time to gather those documents and make sure you have all the right information. And we all know from experience how quickly we can go from, hey, I think I want to buy a home to we want to put in an offer. So if it's within the realm of, hey, I think we might start to be serious about looking, I think moving that pre-approval process forward, knowing that you've got a 90 to 120 day-ish timeline, can be a really smart thing to do for people that are in that search phase. Tony, I want to tap into more of your experience to get your insight on some of the common mistakes that you see out there that are made throughout the lending process, and then we'll continue on talking about some of the different loan options, as well as wrapping up with the closing side of things. We talked about a big one already, which was the credit mistakes, and I love your example of, hey, if you go finance $1,000 piece of furniture and you max out that line, that's a problem, and people might not be thinking about that. So beyond credit mistakes that people can avoid, what are some of the other big mistakes that you see out there that home buyers are making in the process that they could be on the lookout for and ideally avoid?
Yeah, I mean, again, and this kind of going over my career and mistakes that I've seen, and you know, it's one of the biggest things. I feel like nowadays people are much more informed than they were
Hmm.
when I started my career 20 plus years ago. I mean, there's more people are more informed. I think where I see some mistakes now are this type of property you're buying. And what I mean by that is some clients are buying condominiums and they don't always know the challenges that come along with that condominium. Yeah, you may not have to mow the grass or take care of the shrubs or whatever it might be, but HOAs, special assessments, especially in certain states, like, for example, Florida, we had the Surfside incident. There's been a lot of regulatory
Mm-hmm.
challenges that have been placed on condos and made them much more difficult to finance, much more expensive. And I'm not saying don't buy condos. I don't want to, I mean, they're, especially in some states, they're the best option available. Like if you're in a more urban setting, sometimes that's all that's available. It's affordable, but I think doing your due diligence on the building itself is very important. And I've seen some people making mistakes
Mm.
recently in that regard. So if you decide you want to buy a condominium, just, a lot of that's property specific, right?
Mm-hmm.
Um, I think it's also just, making sure you understand the insurance, what comes along with your coverages. Um, you know, some of the insurance companies now are doing roof schedules instead of an entire roof replacement. And look, probably not a lot of worry about that in Ohio, but if you're on the coast in Texas or in Florida and you have a storm that damages your roof, we're seeing some problems with that here right now.
Mm-hmm.
So just understanding the coverages you have. But again, it's very specific to where you are in the country. Um, I think the other thing is floating the market sometimes. I mean, people come to me. What I mean by that is once you get a contract on a home, you're eligible to lock your rate in. And I've mentioned this. I've always been a bit of a finance nerd. So I'm watching the markets, I'm watching bonds, I'm doing all these things.
Mm-hmm.
And I try to give my clients the best feedback I can. And I pass it along to my team. We meet and talk about this daily. But it's volatile, right? It's a volatile market and rates go up and down. I have had some people, and I tend to be people who feel like they're more informed on the markets and typically not medical professionals. It's more like people in the business world that I've
Mm-hmm.
had. And I'll kind of say, my recommendation is lock. Well, I think I'm going to float it. And of course, the rates go up a half point and things
Mm.
like that. And look, I'm not saying I'm always right. I'm not. Clearly, I wouldn't be here. I'd be trading on some island if I knew everything and had a crystal ball. But I think sometimes taking too much risk is a problem. I kind of like a bird in hand. If you've gotten a gain, if the rates have come down a little bit since you've gone under contract,
Mm-hmm.
you might want to lock that gain in. It's always been my experience. Take it off the table unless you really see a downtrend. We saw that during COVID. We could all identify it, but normally, like in this environment, you get a gain, you should take it.
Mm-hmm.
The other thing is just not understanding the type of income you have. And most of your audience, Tim, is W-2'd for the most
Yeah,
part.
most part. Mm-hmm.
But not everyone. Some have 1099 income. A lot of physicians are doing locums, right? They'll come to us and they have some fragmentation in their income because they worked here for 6 months, and lenders don't treat all income the same. And you have to understand that. I had a gentleman in my office just before this call, past client of mine, and he took a lot of losses on his business the
Mm.
last few years. And he had to do it because of some competition abroad. But the problem is, at the end of the day, we got to use what he reported to the
Yeah.
IRS.
Yep.
So you always got to remember, lenders have to use what you reported to the IRS. And people say, "Well, I actually made more than that," but there's ways we can add back certain expenses, like especially non-cash expenses like amortization,
Mm-hmm.
depreciation, some things like that can be added back into your overall income if you're self-employed. But that's another mistake I see, Tim. Again, not is relevant with all of your audience, but maybe someone out there is when you're self-employed, it's important to understand how you're getting paid and what you're getting paid. Are you an S corp? Are you a 1099
Yeah.
LLC? These things are important when you apply for a loan. So there's a little more complexity there, but I think it's important. That's mistakes I see. Is they're almost. I literally have one person under contract right now who we're gonna have to scramble to figure out how to qualify them. They never came to us first, you
Mm.
know, and
Mm-hmm.
it's a pretty substantial contract on a home, like a dream home, but that should have been planned ahead of time and let us review everything before it comes to this. So I know it's long-winded. I'm just
It's
trying to think
good.
of some current things I'm seeing right now in this environment. In the past, there was different risks. Now it's just really property specific, your income. I think the other thing would be how far away you are from your job is important too. It's got to be reasonable, right? You can't be buying a home 200 miles away from where your daily commute is. I've had a few people do that. I'm scratching my head. I'm like, well, a primary home may not be a primary home, maybe a
Yeah.
secondary home. So I think those are the things. Just make sure you have your plans
Mhm.
accurately spelled out to the lender at application.
Yeah, I'm glad you mentioned the self-employed income because you're right. There's not a large percentage of pharmacists. There are certainly some listening out there that need to be thinking about that well in advance. And um, I think communication is what I'd recommend there. Just early communication with the lender so you understand how they would view the calculation and what information is needed. And might take a little bit more work to get all that information to make sure you understand. But certainly a decent amount of number of people in our audience that might have a spouse or a significant other partner that owns a business. I just had a conversation earlier today where a pharmacist is a ED clinical pharmacist, but their spouse owns a construction company. So maybe their income is pretty stable and all W-2, but there might be some self-employed income in there that needs to be factored in for sure.
Thing that a lender can do is if we see, and I've had this happen numerous times, even within your community, Tim, is when we have pharmacists and their spouse or their partner has a business and it's losing money, and we identify that, we say, well, this actually hurts your
Mm,
qualifications. We can tell you that ahead of time, and
hmm
say, help with the guidance of, well, you might be grossing 2,000 a month cash in your pocket from that business, but you're showing it you're losing 500 a month,
right.
right? So that's a mistake I run into as well.
hmm
So
Yeah, what's on your tax return?
that's right.
What's
That's
on your
right.
tax return? Yeah.
Yeah.
Um, I want to talk about loan options and a little bit about interest rates as we work our way through the process. So we started with the pre-approval of the budget. We talked about some of the common pitfalls that happen along the way as well. And certainly getting to the right, quote, right loan option is an important determination. And we've talked at length on previous episodes about the different loan options. So I don't feel the need that we have to go through every single one of those again. And the more you and I have talked, Tony, the more I'm convinced that it's less about the borrower coming and saying, "Hey, this is the option that I want, and this is the rate, that I'm looking for." And it's really about finding that good lender relationship where that person can understand your situation and ultimately apply and recommend what is the best loan option for your personal situation, right? Because you've given me many examples before where someone comes to you and says, "Hey, I really want to apply for the pharmacist home loan," and maybe that's a slam dunk, but maybe they'd be a better fit because of what's going on with rates or credit scores or other things with an FHA product. And so, talk to us about that relationship a little bit and why it's important for the lender and the lendee ultimately to come to that determination of what is the best loan option for their personal situation.
Yeah. I mean, to me, this environment is probably one of the most critical I've ever seen of, because there's been so much change in the secondary market too, where there's opportunities where like during COVID, I mean, there was products that like I wouldn't deviate from,
Hmm.
everyone I could get into one product because the rates were so good in that one area. I tried to, but now things have changed where the secondary market, there's opportunities that arise. So based on credit score, debt to income ratio, there's a lot of reasons why we try to make sure we find the best product. It's not always the pharmacist product. A lot of times it is,
Mm-hmm.
but there are times, scenarios where there's programs that make more sense based on that individual's debt to income ratio, just what we covered today, credit score,
Mm-hmm.
that matters. Pricing can be much better with, for example, FHA. Um, when your credit score might be a little lower, the FHA pricing has gone through times where it's just incredibly good, even though there's some
Mm-hmm.
PMI. So I really try to make sure we're matching that best product. And then there's some geographical programs, depending on where a home buyer is looking, that um, we've used too that are kind of unique to that area based on low to moderate income, even depending on the track you're buying in, census track. There's all sorts of different programs out there, and I try not to limit it or be short sighted.
Mm-hmm.
So we try to look at what the best opportunity is at a given time, and I have done that throughout my career, no matter where, whatever the timing was. Um,
Hmm.
I'll never forget. I'll tell one quick story. It's just, you guys might be too young for this, but but if you ever saw that movie, The Big Short,
Hmm.
you'll remember this. But
Hmm.
during 2004, 5, and 6, 2004 and 5 primarily, Lehman Brothers had this great program. I did a lot of A paper lending. I never did the subprime lending back then. And I was young, but I was the second top producer at the mortgage company I worked for in the country. And I worked really hard. It was 12-hour days. I loved it. I had one part-time assistant, but different times. But Lehman Brothers had this great product where with a second mortgage, we could do 65% LTVs and get the best pricing I'd ever seen. But they were using it for non-doc. They actually had this stated income product, which I didn't do a lot of, but this particular program had just the best rates. Well, I ended up being invited to this call where they were telling me how, oh, we really like this, what you're doing. And basically we'll buy like 100% loans with no income verification and all this stuff. So
Oh,
it was
geez.
crazy times. And
Yeah.
sure enough, a few years later,
Yeah.
everything blew up. But my point is this: we found that the best pricing was through that product, and we utilized it, right?
Hmm.
So, and it helped a lot of our clients. And nowadays there's nothing like that out there.
Yeah.
It's basically pretty vanilla. You have, several different options, but we always try to find the best option for that individual. But I'll never forget being on that call and having that pit in my stomach, being like 27 years old, thinking, it doesn't sound right. It just doesn't sound right. And then a few years later, it all went down.
Here's why it didn't sound right. Yeah. Yeah, I
Yeah.
think there's just a lot to think about here that can be
Yeah.
so overwhelming for a first-time home buyer if they're just Google searching, right? It's,
Right.
they're looking at different rates, fixed rates, variable rates, adjustable rate mortgage products are out there. They're looking at different terms that are out there. They're looking about options that have points or don't have points. They're reading about different loan types and, should I do a 30, a 20, a 15? And how much is it going to take for a down payment? And to me, this is where some of the internet searching, and I learned this the hard way one time where you're excited about buying a home, you put in your information, and all of a sudden the phone starts ringing 24/7, right? And the problem with that is it's not only is it annoying, but it's narrowing you down a pathway too early that may or may not even be the pathway that you want to be on. And I always go back to can there be a lender relationship and can you pick up the phone and call someone, have a conversation about your situation? Hey, I'm looking in this area. This is about what we're thinking, budget wise. And then based on the products, based on all those factors coming together, what is the best product, that's available in that moment for their situation and for the rates that are available. So I'm going to keep beating that drum, Tony, because I think it's so important that someone might go in, and we'll talk here in just a minute about the Pharmacist home loan product, and hopefully that's a good fit. But for some people, they might go into that and say, hey, that is a good option, but maybe there's a better option, that's
Right.
available as well.
That's
Let's
right.
talk about the farm. Go ahead.
Oh, you're exactly right. Because, credit scores, the market, all of that applies. And
Hmm.
we always want to evaluate what's best at this current time. And one other thing I'll mention too is, and it's really one of the safest times that I've ever seen as far as lending goes to buy, because the regulatory environment is very consumer friendly. There's not a lot of, I mean, the rules are in place to prevent defaults, right? And it is overwhelming to some degree, but also there's no more prepayment penalties. There used to be prepayment penalties on lots of these loan products
Hard
20
to
years ago.
believe. Hard to believe.
Yeah. I mean, it
Yeah.
was like everything had you to watch your prepay period and all this.
Hmm.
That's all gone. I mean, so if rates start dipping, which could happen, if we see inflation continue to fall, you could refinance in 6 months, 8 months,
Hmm.
whenever it made sense financially, right? I mean, so it's a very liquid time as long as you qualify. I think there's a lot of from a financing side, it's probably never been safer. You just have to go in understanding that owning a property is not renting, right? You own it.
Hmm.
You got to take care of it. It's your asset. Right?
Hmm. That's right. When we talk about the different products, let's finish this section by talking about the Pharmacist home loan product, as I suspect many are interested. We've mentioned it a few times now. Tell us about the ins and outs in terms of why that product is unique, minimum credit scores, maximum loan amounts, so our listeners can get a feel of whether or not that may be an option that they want to look into.
Sure, sure. So the minimum credit score is 700, but there is some pricing adjustments if you're under 740. So that's why one of the things we do, we will look at some conventional products if your credit score is 701, for example,
Mm.
right? Because
Hmm.
because that it's more sensitive rate wise when you get under 740. So that's the minimum of 700. As far as like the down payments are 3% down if you're a first time buyer. Okay, so only 3% down, no PMI. If you've owned before, it's 5% down. Okay, 5% down, again, no PMI. Um, the maximum loan amount typically matches the conventional loan limits for that area. So most areas right now are about 806, 550.
Hmm.
There are some higher cost areas, that are higher than that. Certain counties, especially around Washington, D.C., California, um, higher cost areas, New York, but for the most part, around that 806, 550 is the loan amount max. So less your down payment, still pretty high loan amount. It's pretty
Hmm.
viable. Um, no prepayment penalties, like I mentioned. There aren't really a lot of reserve requirements either, so you don't have to have a lot of of cash in the bank, so to speak, in reserves. And then the seller is able to pay some of the closing costs as well, which is helpful sometimes,
Hmm.
especially as there's more inventory, guys. Sellers will be more willing to negotiate. That is one of the benefits of inventory.
Hmm.
So the more inventory grows, the more opportunity there is for buyers. They get a little bit more leverage than they used to have. So the ability to have closing costs paid by the seller, something that could be negotiated in, and this program allows that as well.
And available in the lower 48. One of the reasons that we've had
Yeah,
this
yeah,
on,
yeah,
you'll
yes,
find
yeah,
some regional products or state specific products, but any pharmacist listening that's living in the lower
great.
48, this is an option. And we'll link to this in the show notes. But if you go to yourfinancialpharmacist.com/home-loan, you'll find all the information Tony just mentioned, as well as some other resources for those that are looking to purchase a home. Tony, I'm glad you mentioned the reserves as well, because when I think back to my journey of being a first time home buyer, or for that matter, even buying our second home, that's a place where a lot of people can get stuck, right? Which is, hey, we're working hard to come up with a down payment. And now we got to have a certain amount that's in reserves as well. And liquidity, we know, is just a difficult thing for a lot of pharmacists that are in the first 5 or 10 years of their career. Just given that there's other demands on income, they're paying off student loan debt, they're working towards other goals. So that minimal reserve requirement can be an important aspect that I think we probably don't talk enough about when you and I talk about the pharmacist home loan product. So thank you for the reminder on that one there. Let's wrap up by talking about what really happens behind the scenes from, hey, I've got my pre-approval. I go out, I find the home, I'm working with the realtor, I make an offer, we're under contract. Walk us through what's happening behind the scenes from I'm under contract ultimately to closing, because I think this is it feels probably for a lot of people like a black box of all these things that are happening. You guys I know are working really hard. People want to close on time. They want the process to move forward without bumps. Spoiler alert, it's probably going to have some bumps along the way. That's just part of the process that happens. But what happens behind the scene from, hey, we've got an offer, we're under contract, all the way to we're signing out documents and we're getting the keys?
Yeah, great questions, right? There's a lot that goes on behind the scenes, and everyone's situation is different. It's really amazing how many different things can happen. But once you go to contract, once you've gotten your pre-approval, you've gone to contract on a home. Yes, have part of the battle's done, but there's still a lot more left before you close. And so most contracts have a timeline, right? Of, let's say it's a 30-day contract, okay? There's typically a commitment letter deadline. So that's when your financing contingency is up, so to speak. So what that means is, like any earnest money you gave, let's say you
Mhm.
gave $5,000 to secure the contract, that money is basically non-refundable if you get denied for financing after the commitment letter deadline. So it's very important you have a lender that can meet that deadline to minimize that risk. So that's the first thing we look at. Like, when is that deadline? When's the appraisal contingency? And we work on those contingency basis. I'm very fortunate here, and I've worked at two other lenders in my career, and I've been at this bank now for a little over 7 years now. I think it's been, yeah, a little over 7. And we have probably one of the best operational systems I've been a part of. And basically having my own team, it's made it a lot easier for me.
Mm-hmm.
And the reason I'm going to mention this is I'm going to speak to a couple different systems of how lenders work, because I've worked at different systems and I've seen it firsthand. So the black box, so to speak, is once you go to contract, you send all your financials into the lender. Everything starts, right? Normally, that loan originator will send the file to the processor. The processor on my team, I have 2 or 3 that work for my group, will then submit the loan to the underwriter. Okay. And we have a fast track policy as well. So a lot of our products, we can have a loan commitment if we have a full file within like 48 hours of receipt. It happens very, very fast. And that's one of our advantages is the speed that we can get that approval and meeting those criteria. And then from there, the appraisal's ordered as well. Generally takes a week or 2 to get that appraisal back, I find. Most areas, a week or 2. And that'll meet that, as long as that appraise is okay, then that meets the requirement, right? And the appraisal's reviewed too. So going back, processor submits to underwriter, you get the approval. Okay, so the loan's been approved, formally approved. There's generally conditions with that loan. So you're going to have conditions that have to be collected from the borrower to get the final approval. During that time, the appraisal's ordered, right? Typically, all your inspections are done with your real estate agent ahead of time, before you get this far or during that time. But this is all being worked on at the same time. So conditions, a lot of times, is just how quick do they come back from the borrower. Generally, it takes a borrower a week or so, to get it back to you, right? It's not something that they're going to just shoot right back to you. Some people do, but some people just take their time, especially if our underwriting approval happened quickly. But we'll get those documents back. We'll resubmit it for the, to get the final or formal, to clear up any conditions right before closing. And sometimes there's more back and forth depending on if those conditions didn't quite fit the requirements. Okay. Appraisal comes back, appraisal's reviewed. Typically a week or so prior to closing, our closer will work with the title agent or the closing attorney to get the correct paperwork for closing and the correct documents prepared. So they start doing it ahead of time to meet the new I say new, but several years ago, TRID became a requirement where a borrower had to acknowledge the closing statement at least 3 business days prior to closing. So that's why you have to sign off on a primary home at least 3 days prior to closing and review all the financials, and then you can close 3 business days later. So that is done at least a week ahead of time with the settlement agent. So meantime, most transactions go pretty smooth where there's some complexity in underwriting when you're self-employed, but most clients have W-2s, pay stubs, comes in, we get it underwritten quickly, and the appraisal's ordered, and we work to the final loan approval. Closer gets the paperwork out, then the client goes, signs on the closing day, loan is funded. So that's behind the scenes black box. Now, there can be some moving parts. So I worked at a larger bank prior to coming here, and there were some years I was their top producer in the country even, and they were big. They're very big. I'm not going to name them, but they're a bigger bank. And we used to have operations that I could somewhat control, meaning my processor, right, and my underwriter. I had a group that knew me, our system, my team. They basically centralized that, and it became where I lost complete control. And it would truly be, I wouldn't know what's going on, right? So I couldn't update my clients, and
All the while
unfortunately,
they're asking questions and
yes,
Yeah.
And unfortunately, a lot of banks work that way even to this day, especially the larger ones, because it can be, they're not as nimble
Hmm.
to manage smaller teams like we are. So that is one thing you see out there, is there's still some of that out there where it's call center driven, it's centralized, and it's hard to move quickly. It's hard to communicate. And that's
Hmm.
where some of these problems can arise. And that's why I do think it's important to have that communication, because things happen. There is things that
Yes.
happen. Like even in the appraisal process, we had an appraiser couldn't find comparables. They're coming back to our team. Those are the things that happen. They
Hmm.
just are out of our all of our control. There's things with job movement. People take new jobs, and I'm dealing with one right now where the employment agreement got kicked back a few months, which that could, still want to close early, and it's, there's always complexity, right? You just want to try to get answers quickly
Yeah.
and communicate quickly, but there's a lot that goes on behind the scenes. I don't know how much more depth you want, but I mean, there's flood certifications that are run,
Yeah.
right? There's During the process, we track any inquiries on your credit to make sure you're not borrowing other money,
Not a good time
right?
to be
Yeah,
doing
lenders do
things.
that. We have to do that. So we track people and make
Yeah.
sure. That's why I say don't buy stuff while you're going through the
Yeah.
process, but you're being tracked during the process, making sure your credit's not being utilized.
Yeah.
There's a lot of things. There's a survey that's ordered. Typically, the title company will do
Hmm.
that, but you're getting a survey on the home. You have to get homeowners insurance. But the lender is working through a lot of little details. We do fraud guard. There's different things we do to ensure that there's no fraud with any of the parties involved. Seller, title company, all of that. A lot of things are screened now that they weren't in the past. So there's a lot that goes on. But if you have a system, it can be done quickly. If you have it, and if you get the materials. I will say one more thing for the audience. The better you are at responding to the lender with the items they need quicker,
Hmm.
the quicker the process and smoother it'll go for you.
Yeah.
So whoever lender, no matter what lender you choose to use, if you respond quickly and you're proactive and you get them what they need when they request it, the process will go much, much better for you.
Well, I'm going to give a shout out to our audience there because I would contend that most pharmacists, maybe not all, but most pharmacists are pretty responsive and
Very,
communicative in the
yes.
process. And probably, not probably, I know why that for many people, having that relationship would be so important for all the reasons that you mentioned, right? And there's really two things that I heard there. One, a team that is not decentralized, in terms of, or I guess centralized in the way that you described it, where you don't have access to them and kind of that black box becomes what we were talking about. So having that access to a team where you can get that information quickly back to the client. And then again, just that personal relationship, I think matters a lot. Call me old school, but it's what I say on the business side all the time. We work with a local credit union here where whether it's related to, some of our checking accounts or a line of credit or whatever is the question, like I know I can call Meredith if I have a question. And maybe Meredith won't always be the direct person that answers my question, but she can help me get in contact with whoever is. And, when someone knows that, hey, I can talk with Tony or I can talk with Cindy or I can talk with Aaron, like, and there's a real person who understands my scenario, all the more important when we're talking about a highly emotional, large purchase with lots of moving pieces and parts in a very short period of time, right? That's a recipe for stress. And I think having the right people in your corner and having access to them and having good communication back and forth can make this go as smooth as it hopefully will, knowing that there might be some bumps along the way as well.
Yeah, absolutely. I think, one of the things about this industry is there's so many little details, right? Even like,
Hmm.
how can I bump my credit score up 20
Yeah.
points? Having that ability to talk through that, it's complex. It's not something, I remember thinking one time, well, maybe AI will take away a lot of our business. Well, it's funny, the AI things I sit in on and listen to, it's all just making our business more efficient. There's just too much complexities for a computer. Everyone's so different. You
Hmm.
can't standardize it. Everyone's got a different situation. So
Hmm.
um, the personal approach, I think, is always going to be needed. There's a lot of complexity in lending, a lot of things that you can't just put in a box. But there's a system behind it. And I do think from what I think there's so many more protections now for the end user and the client than there ever has been.
Mhm.
It's really even though it is an intimidating process, it's as safe as it's ever been.
Tony, this is great stuff, and we covered a lot from pre-approval to closing. And we have a great resource that I've referenced once. I'll reference it again. We'll link to in our show notes called Five Easy Steps to Get a Home Loan, even if you don't have 20% down. You can find that by going to yourfinancialpharmacist.com/home-loan. It's a great resource for home buyers. In there, you'll find some more information about the Pharmacist home loan offering, recapping much of what Tony described on the show as well. And again, we'll link to that in the show notes. So, Tony, as always, really appreciate your perspective and thanks for taking time to come on the show.
Thanks, Tim. Always good hanging out with you, man. Thank you.
Appreciate it. Take care.